Welcome back to Chapter 17 of Price Analysis, a fundamental approach to the study of commodity prices. And in this portion of the video, we're going to talk a lot about recent price trends in major energy markets. And what we've got up on the screen here are the two price series, West Texas Intermediate crude oil, which is the North American benchmark crude oil price, and the Brent crude oil price, which is the benchmark of oil that comes out of the North Sea region. And you can see that, as you might expect, there is a close correlation in the prices of West Texas Intermediate and Brent crude oil because it's easy to trade crude oil globally, so there could be significant spatial arbitrage if these prices diverge too much. There's a few important things to notice about this plot, though. One is the major spike up in crude oil prices and crash down that happened in 2008-2009. That coincided with the financial crisis, and this spike up and crash down was seen across most commodity markets, and it caused quite a disruption in any industry that basically relies on commodity markets. Now, the other thing that's important to notice about this chart is the unprecedented divergence in the Brent crude oil price and the West Texas Intermediate crude oil price during this period from about 2010 until 2013. And then after we had kind of a secondary crash in crude oil prices since late 2013, the prices of Brent and West Texas Intermediate have been a little bit more in line and haven't been diverging as much as they were in this period. To illustrate how dramatic this divergence between Brent and WTI was during that period, I've here plotted in this chart just the spread between Brent and WTI. So we've taken the Brent price and subtracted off the WTI price in dollars per barrel. And we discussed how historically, since Brent crude oil is a little more sour, it usually trades at a discount. This is exactly what we mean by that. Over recent history, especially prior to 2005, 2006, Brent crude oil always traded at a bit of a discount to West Texas Intermediate. Since 2006, all bets have been off on that, and we had a couple of years where West Texas Intermediate was the one trading at a pretty significant discount to Brent crude oil. And then the relationship kind of came back in line, but we see it kind of diverging again. So let's explore what could be causing this divergence in the Brent WTI crude oil spread. So the next thing I want to do is take a look at fundamental factors in the production of crude oil in North America, and particularly in the United States. So let's scroll down here and take a look at this chart a little more closely. This chart takes information from the EIA, the Energy Information Administration, and it's about U.S. field production of crude oil in 1,000 barrels per month. So this chart is really striking because it shows that prior to 2007, 2008, crude oil production in the United States had been steadily declining for quite a long time, 20 or 30 years. Then, all of a sudden, production in the United States started to shoot back up at a very rapid pace. Now, what spurred that increase in production? It was basically the introduction of the cost-effective hydraulic fracturing techniques that allowed crude oil to be pumped out of deposits that were previously too costly to extract from. And one very important one is the Bakken Formation in North Dakota. And we've seen a huge boom cycle in crude oil production in that region. So here's what I'm talking about when I'm talking about the Bakken Formation here in North Dakota and eastern Montana. This figure shows the number of wells in 2008, and I'm going to zoom this out so we can compare. And down here we have the number of wells in 2013, I believe. Yes. So you can see the tremendous increase in the number of wells extracting crude oil out of this deposit in the North Dakota region. And that's had a tremendous impact on global crude oil markets. And that accounts almost exclusively for this dramatic rise in U.S. field production of crude oil in this chart. All right, one more piece to the puzzle, and then we'll try to put together all these fundamental factors and interpret what was happening with the price. So the last thing I want to talk about is this chart of U.S. ending stocks excluding the strategic petroleum reserve of crude oil. All right, so the major feature of this chart is that inventories historically have been pretty incredibly stable, even through the giant boom and bust of the 2008-2009 period. Except, here at the last part of the graph, recently we have seen a dramatic spike in crude oil inventories, and only recently have inventories started to come off that historical high. So let's take all of these factors together and go back to the price chart. Okay, let's start with the price and levels. The easiest one is probably to correlate the dramatic rise in inventories in the United States with this giant crash in crude oil price that has led to phenomenally low crude oil prices from a recent historical perspective. Okay, and in the last couple of months, as we've seen inventories come off of those highs, we've seen a little tiny bit of a rally in crude oil prices in the last couple of months. That all makes sense. Now, let's talk about this price chart, the spread between Brent and West Texas Intermediate. Now, this particular blip, let's note the date. The height of the blip is kind of centered around this April 2012 date. So let's go back down here and look at one of our charts and notice that April 2012 was when we were really starting to ramp up production in the Bakken region of the United States. And the next couple of years would see a tremendous growth in U.S. field production of crude oil. So what that means in the United States market, where we would have been reliant on crude oil being imported from other parts of the world, including Brent crude from the North Sea. Suddenly we're producing it domestically, and that means that probably we can buy West Texas Intermediate more cheaply than importing Brent crude oil. Makes sense. We're producing a lot of domestic oil. The domestic price will be deflated a little bit. And if we're using WTI crude oil in the United States, then for at least a brief period, we're not arbitraging this across space. So we're not exporting WTI crude oil to get the higher European prices that are reflective of the Brent crude oil price. But that seems to have corrected itself, especially since our dramatic stocks have been increasing in recent years. I don't have this chart built into the textbook yet, but it is informative. If we go to the EIA website, we can see the U.S. exports of crude oil over a very long time series. And you can see over the recent 20 or 30 years that we have been focusing on in our textbook, crude oil exports have been modest, and since 2000 have been essentially non-existent. And as exports of U.S. crude oil have risen dramatically since 2012, dare I say April of 2012. We see this, if we go back to the price chart, the price spread, we have seen that spread being corrected in the Brent and West Texas Intermediate. Okay, so obviously U.S. producers of crude oil said, or U.S. exporters said, hey, we can buy cheap WTI, we can send it to Europe and get a higher price for people used to paying the premium for Brent crude oil, and we can make a spatial arbitrage. So I think that's the big reason why we've seen exports shooting up in recent time. Okay guys, that is a good place to stop this video. We're going to have one video where we talk about the crack spread.